global financial system is quietly changing, and most people won't realize it until it's too late. The US dollar faces growing resistance. Commodities are experiencing historic volatility, and crypto may be entering a macro turning point. While headlines spread fear, institutions are repositioning beneath the surface. Today, we connect geopolitics, market cycles, and technical signals into one clear investment narrative. Welcome back to Preyo Promo, where we go beyond headlines and break down the forces actually driving markets. Today's episode is a full deep dive into 5 massive developments shaping global finance right now. The weaponization of the dollar, the silver market shock, regulatory catalysts, technical market structures, and long-term cycle theory. This isn't hype. This is macro analysis, built from multiple market sources and cross-referenced insights, designed to help you see the big picture before the crowd reacts. Let's begin with the foundation of global finance itself. Module 1. The Weaponized Dollar and the Rise of BRICS, 12 Min. For over 70 years, the US dollar has operated as the world's reserve currency, dominating global trade, energy pricing, debt settlement, and central bank reserves. But since the geopolitical disruptions of 2022, something fundamental changed. Perception. When sovereign reserves were frozen, many nations began questioning a critical assumption. Is global reserve money politically neutral? The BRICS push back. The BRICS nations are not attempting a sudden overthrow of dollar dominance. Instead, they are quietly building alternatives: local currency settlements, bilateral trade agreements, commodity-backed discussions, cross-border digital payment networks. This creates what analysts call a dual-system future, where parallel systems coexist rather than compete directly. The yuan question. Many investors expected the Chinese yuan to become the direct successor to dollar dominance. But global adoption requires transparent capital markets, predictable legal frameworks, open currency convertibility. These barriers slow adoption. However, China's real strategy may focus less on replacing the dollar and more on replacing the infrastructure that supports it, including digital settlement rails and CBDC ecosystems. Investor interpretation. Major monetary shifts rarely erase wealth. They transfer it. Historically, during trust transitions, markets reward scarce commodities, hard assets, digital assets with provable scarcity. The message for investors is clear. Diversification becomes survival during monetary evolution. Module 2. The 40 Silver Meltdown and the 6 Sigma Event, 10 MEN. Reference, v.q.uk. While retail investors focused on Bitcoin volatility, the silver market experienced intense structural stress. The reported liquidation event revealed how leveraged modern commodity markets have become. Why silver matters now? Silver is no longer only a store of value. It sits at the center of solar energy infrastructure, electronics manufacturing, industrial technology. Supply disruptions therefore ripple across global production chains. The China factor. Export adjustments and supply controls triggered a market shock. Analysts describe the volatility as a Six Sigma event, statistically rare enough to expose hidden leverage. When volatility spikes unexpectedly, market makers widen spreads. Liquidity dries up. Leveraged positions unwind rapidly. The institutional angle. Large institutions often benefit from panic. Mechanisms like ETF arbitrage and derivative hedging allow them to absorb supply while retail traders exit emotionally. This is not conspiracy, it is market structure. Crypto parallel. The pattern mirrors crypto cycles, sharp liquidations, fear narratives, silent institutional accumulation. Volatility becomes a transfer mechanism from weak hands to strong hands. If you're enjoying this deep breakdown, subscribe to Preyo Promo, because we focus on understanding macro trends, not chasing headlines. Let's continue. Module 3. The March 1st Catalyst and the Clarity Act, 10 Min. Markets move on expectations, and regulation often acts as the catalyst that unlocks institutional participation. The significance of the legislative timeline lies in clarity, not restriction. Regulation is validation. For years, digital assets existed in legal gray zones. Institutional capital avoids uncertainty. Once clearer frameworks emerge, compliance departments approve exposure. Pension funds gain confidence. Regulated products expand. Wall Street positioning. During bearish sentiment, major asset managers frequently accumulate positions quietly. Historically, retail sells during fear, institutions build during uncertainty. This deep value zone behavior appears repeatedly across market cycles. Market psychology. When headlines emphasize risk, long-term investors examine fundamentals, adoption growth, infrastructure development, expanding institutional participation. This creates divergence between sentiment and positioning. Module 4. Technicals. Falling wedges, RSI extremes and short squeeze potential. Charts reveal emotion translated into price action. Bitcoin's current pattern resembles a falling wedge, historically associated with declining selling pressure and potential reversals. RSI extremes. The relative strength index on higher time frames reaching extreme oversold levels signals momentum exhaustion. In previous cycles, these moments preceded major recoveries. The short squeeze setup. Billions in leveraged short positions sit above key resistance zones. If momentum flips, liquidations cascade, buy pressure increases automatically. Volatility accelerates upward. One strong move can trigger chain reactions across exchanges. Tokenization, the bigger narrative. Beyond short-term charts lies a structural transformation. Real estate tokenization. Bond settlement on-chain. Fractional ownership models. This is a multi-trillion-dollar infrastructure evolution that could redefine capital markets over the next decade. Module 5. Cycle Theory. Roaring '20s or Great Depression. Every market cycle feels unprecedented. Yet human psychology remains predictable. Extreme fear indicators historically appear near market bottoms rather than tops. Sentiment versus reality. Despite recession narratives, employment resilience remains strong. Corporate earnings show adaptability. Capital continues flowing into innovation sectors. Markets often recover before public sentiment improves. Ethereum and Solana signals. Network activity and developer growth suggest continued ecosystem expansion despite price compression. Oversold conditions combined with strong utility often define late-stage corrections. The final flush theory. Cycle analysts describe this phase as the capitulation stage. Leverage exits the market. Weak conviction sells. Long-term holders accumulate. This phase feels uncomfortable by design. Final synthesis. Connecting all modules. 4 min. Let's connect everything. Monetary systems are becoming multipolar. Commodity volatility reveals hidden structural stress. Regulation is shifting toward integration. Technical indicators suggest compression nearing exhaustion. Cycle theory aligns with late-stage fear environments. Together, these signals suggest transition, not collapse. Markets don't reward emotion. They reward preparation. Whether this becomes the launchpad for a new expansion cycle or another phase of consolidation, the investors who win are those who understand the macro framework, not just daily price swings. If you made it this far, you're already ahead of most market participants. This is Preyo Promo, where we decode the market before it becomes obvious. See you in the next breakdown.